Hi there, welcome to Market Call. David Burrows is on our show today. He's President and Chief Investment Strategist at Barometer Capital Management. And David will take your calls, emails, tweets and video questions on North American large caps. Great to see you.
Great to be here.
Toll-free number 1-855-326-6266. Send us an email. The address has changed slightly. It's now marketcall@bnnbloomberg.ca. David, I got to ask you, are you concerned that the whole US market is too narrowly being dragged higher by the tech stocks? I mean, Amazon, Google.
Absolutely not.
You're not worried? Okay.
Absolutely not. So there's a few things you can look at. There are lots of people who would say these FANG stocks have been what's been dragging everything higher.
Okay.
It is absolutely not the case. So I track breadth. That's what I do. The percentage of stocks or securities in specific universes that are participating in a rally. And breadth has been slowly expanding since March. So that means it's getting better, not worse. There's no major sell-off in history that ever took place while breadth was expanding. That's a market getting healthier. If you look at the Value Line Arithmetic Index, it's an index of 1,700 major U.S. stocks, unweighted. So they all are worth the same in the index. It's already hit a new high.
In
the
breadth?
S&P has not. No, the
sorry.
index itself has hit a new high
for
the year.
What index?
The Value Line Arithmetic Index.
Which is a very broad measure.
Which is a 1,700 stock index that is unweighted. In other words, every stock is worth the same.
I see what you mean.
Not like the S&P where the top 10 stocks are a huge percentage of the index. So that tells you it's not just 4 or 5 or 6 stocks. It's the broad market that's getting better, and you cannot argue that. So I would make the case that we have had a very healthy bull market correction. It happened in 8 days.
Well, let's put up a one-year chart for the S&P 500 while you're talking, David.
Sure.
Go ahead. Okay.
So we had 2 years with very low volatility, and in January, in 9 days, we had an 8.8% correction. And that is like a sharp punch in the face, especially given the fact we'd had no volatility. That was the low point. We've tested that low a number of times. Each time the low was higher, and breadth has been improving all the way through it. So if you look at the NASDAQ, it's made a new high. If you look at the Russell 2000, it's made a new high. Mm-hmm. Most importantly, this Value Line Arithmetic Index, which is unweighted, has made a new high. Market's very healthy, and I believe we're just starting the next leg, which I think will be significant, because there's no bull market in history ever came to an end when everyone was skeptical and had been pulling back on their exposure. You know, the average hedge fund has reduced its long exposure by 50% since January. There are more people short S&P 500 contracts today than any time since 2015. That is not how a bull market ends. It ends with everybody out over their skis believing that we are sailing into a new, better world.
I like that. What about Canada and the States? Where would you put money right now, if it's possible to generalize?
So we have at our firm about 80% of our assets in U.S. equities because that's where conditions are getting better for business, right? In Canada, sadly, we're going the other way. Regulation, political speak, and taxes. However, there are some spaces in the Canadian market that appear to be starting to participate. And while energy's been a little mushy over the last couple of weeks, it is one area. Some of the transport stocks, some of the more cyclical reflationary assets we think can participate in this next leg.
We'll be back with David Burrows of Barometer Capital Management. David is answering your questions on North American large caps. Give us a call, 1-855-326-6266. That number again, if you're listening to us on the radio, 1-855-326-6266.